Good morning and welcome to the Post-Monetary Policy Committee press briefing. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, the 6th of August 2024, and today the Governor, who is also the Chairman of the Monetary Policy Committee, will be taking us through the thoughts that the MPC had, and we'll also take your questions after that. So as is usual, the Governor will go through his presentation and you can send in your questions through Slido. That's www.slido.com. The meeting code is hashtag MPC0824. So without further ado, I'd like to welcome and invite the Governor of the Central Bank of Kenya, Dr. Kamau Thugge.
Thank you, Wallace, and good morning, everyone. During its meeting on August 6, 2024, the Monetary Policy Committee lowered the central bank rate, the CBR, from 13% to 12.75%. The MPC noted that its previous measures have lowered overall inflation to below the midpoint of the target range, has stabilized the exchange rate, and anchored inflationary expectations. The non-food, non-fuel inflation has moderated, while central banks in some major economies have lowered interest rates in response to easing inflationary pressures, with indications that other central banks will soon embark on a similar trajectory. The Monetary Policy Committee concluded that there was scope for a gradual easing of the monetary policy stance while ensuring continued exchange rate stability. The MPC will closely monitor the impacts of the policy measures as well as developments in the global and domestic economy and stands ready to take further action as necessary in line with its mandate. The committee will meet again in October 2024. In reaching its decision, the committee considered developments in the global economy and noted that global inflation had moderated, but the pace of the decline had slowed down. Headline inflation rates in the major economies have continued to ease, but the pace of the decline has slowed down. The core inflation rate has remained sticky in the advanced economies, mainly driven by services and wage price inflation. Global inflation is expected to decline from 6.7% in 2023 to 5.9% in 2024, reflecting the impact of tight monetary policies and cooling labor markets in the US. However, the pace of decline in inflation, global inflation, has slowed down, reflecting persistence of higher than average inflation in services prices and nominal wage growth attributed to wage negotiations in some countries earlier in the year. With regard to oil prices, the international oil prices have moderated. However, an escalation in geopolitical tensions in the Middle East could result in higher oil prices in the second half of 2024. The OPEC Plus member countries met on August 1st, 2024, and reiterated the group's intention to start unwinding the 2.2 million barrels per day voluntary production cuts from October 2024. With regard to food inflation, inflation has continued to decline with the improved supply of key food items, particularly of sugar and cereals. As you can see there, the overall global food inflation is projected at -3.1%, and that reflects the decline in inflation on sugar prices as well as the cereals prices, mainly because of the improved supply in Argentina and Brazil for maize, but also the improved supply of sugar in India as well as Thailand. And the reduction in sugar prices and cereal prices offset the increase in edible oil prices, resulting in a negative 3.1 overall global food inflation. In regard to the global economic outlook, global growth continues to recover, supported by strong growth in the United States and improved growth prospects in some large emerging markets, particularly India as well as China. World economic growth is projected at 3.2% this year. This is according to the July 2024 WEO projections of the IMF, and it should increase by 0.1 to 3.3% in 2025. There's strong performance by the United States, whose growth increases from 2.5 in 2023 to 2.6 in 2024, and already we've seen a fairly strong performance in the United States in the second quarter, with growth having accelerated to 2.8 from roughly 1.4% in the first quarter of this year. Similarly, the United Kingdom and also the euro area, we should expect some improvement in growth. In the United Kingdom, we should see an increase in growth from 0.1 to 0.7 for this year, and a further acceleration to 1.5 in 2025. For the Eurozone area, the growth was only 0.5% in 2023 and reflected the contraction in growth in Germany of minus 0.2, but that is expected to be reversed this year and to have a positive growth of 0.2, resulting in the Euro area growth at 0.7% this year, and then a further acceleration to 1.5 next year. In the case of emerging market and developing economies, China's growth has been revised upwards in the July WEO projections. Initially, it was 4.6 for 2024, and this has been adjusted upward by 0.4 to 5%. And similarly, the growth in 2025 has been adjusted upward by 0.4 from 4.1 to 4.5. India's growth continues to be very robust, having recorded a growth of 8.2 last year. This year is expected to grow by 7% and a further 6.5% next year. In the case of Sub-Saharan Africa, the growth for 2024 has been revised downwards by 0.1, and that also reflects the revised growth in Nigeria by 0.2%, so that now Nigeria is growing by 3.1 rather than the previous 3.3%. By way of comparison, Kenya's growth in last year was 5.6, and that was higher than obviously the global growth. It was higher than the advanced economies, and was also higher than the average for the emerging market and developing economies, which recorded a growth of 4.4%. And for Sub-Saharan Africa, the average growth was 3.4 compared to 5.6 in the case of Kenya. And going forward, the same pertains in 2024 as well as in 2025, where the average growth for Kenya is higher than the other regional averages. In the case of the global financial markets, the markets have remained stable, and this has been reflected in the improved performance in the equity markets. And to a certain extent, this improvement in the equity markets reflects improved global economic conditions, and also the easing of eased financial market access for the emerging and developing economies should result from this stable global financial markets, particularly as the advanced economies start to lower their interest rates, and we hope that that will reduce the cost of funding, and that emerging economies and developing economies can access international capital markets at reduced interest rates. So the key takeaways on the global developments are the following: that global growth remains steady in 2024, supported by strong growth in the US, but also improved growth prospects in China as well as India. The risk to the global growth outlook relates to the elevated geopolitical risks, particularly the war in the Middle East and increased uncertainties with respect to political factors such as the elections in some of the major economies. Global inflation continues to decline, but the pace of decline has slowed down, and this is largely due to the persistence of higher than average inflation in the services prices. Interest rates in advanced economies are expected to remain higher for even longer due to expected persistence in inflation above their targets. But central banks in some major economies have lowered interest rates, while the US Fed is expected to commence interest rate cuts from September 2024. And finally, Kenya's real GDP growth is expected to remain above the global sub-Saharan Africa and emerging market and developing economies averages in both 2024 and 2025. Moving to the domestic economy, the monetary policy measures that the central bank has implemented have lowered inflation, stabilized the exchange rate, and anchored inflationary expectations. Overall inflation declined to 4.3% in July of 2024 from a peak of 9.6% in October of 2022. Food prices have declined, reflecting improved weather conditions and lower international food prices, and the impact of fiscal measures implemented by the government to moderate the price increases of specific commodities. Fuel inflation has eased on account of lower international oil prices, and non-fuel inflation has moderated on account of the impact of monetary policy measures. And finally, the appreciation of the exchange rate has reduced imported inflation. Overall inflation is expected to remain below the midpoint of the target range in the near term, and this is supported by a stable exchange rate, but also improved food supply attributed to favorable weather conditions, as well as the stability in fuel prices. Turning to the components of the domestic inflation, we see that overall inflation did decline in July 2024, and this was driven by lower fuel, but also the non-fuel inflation component, and also stable food inflation. So inflation did decline from about 4.6 to 4.3 between June and July. And the main component of inflation that had the most impact was the fuel component, which declined from 6.4 to 4.5%. The food component remained unchanged at 5.6 and 5.6. And in the case of non-fuel inflation, there was a small decline from 3.4 to 3.3. In terms of the contribution to overall inflation, again, in looking at July 2024, you can see that at about 2.2 percentage points of the 4.3% inflation came from food, and 1.2% came from fuel, and about 0.9 came from the inflation in the non-fuel component. In regard to the non-fuel, this inflation had stabilized, had remained at around 3.6 from January to about April of this year. and then declined to 3.4 and remain for the 2 months, May and June, but has declined to 3.3. And this downward trajectory in inflation reflects the impact of the tightened monetary policy that the committee has taken in the last few months. In regard to the contributions to food inflation, you can see basically a turnaround. If you go back to October of 2022, you can see that most of the inflation then, of 15.8, had come from non-vegetable, and only a small percentage was coming from vegetables. But as of July, we see that actually the contribution of non-vegetable is actually negative, but most of the food inflation of that 5.6, in fact 6.1, is actually coming from the vegetables, and minus 0.5 is coming from the non-vegetable inflation. Just looking at more details on the non-vegetable inflation, you can see that the contribution of maize, wheat, milk and edible oil prices to overall inflation has been, there's been a consistent reduction in that inflation, starting with the 3.1, these are percentage points, 3.1 percentage points in October of 2022, and that declined consistently up until August of 2023. It was still positive and then turned negative, and as of July 2024, the contribution of non-vegetable inflation to overall inflation was actually negative 1.1. The other factor that contributed to lower non-vegetable inflation is sugar prices, which again you can see that in July, compared to July of last year, sugar prices had declined by 22.3%. And as I said earlier, this reflects the increase in production in both India as well as Thailand. And this reduction in sugar prices by 22.3% has contributed to a reduction in overall inflation by minus 0.3 percentage points. Again, this is where there are some issues where vegetable inflation has accelerated. Between June and July, it has increased from 28.1% to 32.6%. And essentially, we see prices of onions have increased, prices of tomatoes have increased, and prices of potatoes as well, and sukuma wiki have also increased. And in a sense, this higher prices reflect the excessive rains that and floods also that were experienced in April and May of 2024, which disrupted the supply of key vegetables. Nevertheless, in the July 2024 Agricultural Sector Survey, we have seen that the survey indicates that the prices of onions and tomatoes and other key vegetables are likely to decline in August due to improved supply following the increased domestic production. With regard to fuel inflation, that has declined further in July of 2024, and this reflected the impact of the downward adjustment in pump prices, lower electricity prices, and also reduced transportation costs. So the fuel inflation has decelerated, as I said earlier, from 6.4% to 4.5% in July. Looking forward, the July 2024 Agricultural Sector Survey shows that most respondents expect inflation to decline or to remain unchanged in the next 3 months. So about 82% of the respondents which is an increase from 57% from the May 2024 survey. The 82% expect inflation to either decline or to remain unchanged, and only 18% think inflation will increase. And this high percentage of respondents who expect inflation to decline or to remain unchanged is because they believe that the food supply would increase with the expected harvest. There is the continued stability of the exchange rate, and also the stability in fuel prices, and possibly a reduction in pump prices. So moving to the domestic economy and economic growth, the economy remained resilient in the first quarter of 2024, growing by 5%, and this is compared to 5.5% in the first quarter of 2023. And this resilient performance reflected continued strong performance of the agricultural sector due to favorable weather conditions, as well as the robust performance in the services sectors. However, the performance of manufacturing and construction sectors was subdued, partly reflecting higher production costs and also the construction costs in the first quarter. The growth of the economy is expected to remain resilient in 2024 and is projected at 5.4% in 2024 from 5.6% in 2023. And this growth will be supported by sustained agricultural performance, again due to favorable weather conditions, and also government interventions, particularly in the area of fertilizer, and continued robust performance of the services sectors, and improved exports supported by improved global growth prospects that I just mentioned a few minutes ago, and ongoing trade initiatives. For example, the tripartite agreement between COMESA, EAC, and SADC, and also the AFC FTA, and the recently concluded Kenya-EU Economic Partnership Agreement. The main risk to the Kenyan economy relates to increased global uncertainties, particularly the potential negative effects of the heightened geopolitical tensions. So looking at the details of the domestic economy, we see that looking at the very bottom line that says real GDP growth, we can see that for 2023 we recorded a fairly strong growth of 5.6. The first quarter of this year we have recorded a growth of 5%, and we expect growth in this year of 2024 to be about 5.4%, and for next year a growth of roughly 5.5%. And as we've said in the past, we expect real GDP growth over the medium term to be roughly around 5.5%. So again, so we have a resilient agricultural sector growing at 6.5% last year. We had a very strong performance in the first quarter at 6.1%, and therefore we expect that momentum to continue for the rest of the year, and for the agricultural sector to record a growth of 6% for the year as a whole. The industry sector, there are some disappointments. The usual culprits, the manufacturing did relatively badly in the first quarter, growing by 1.4%, and based on that not so good performance, we have lowered the projection for manufacturing growth from 3% to 2.3%. And similarly, construction did very poorly in the first quarter, growing by only 0.1%, and we have had to pare down the growth of the construction sector for the year as a whole, and we're now projecting a growth of 2.4. The services sectors continues to be robust. Last year they grew by 7%. The first quarter remained fairly strong at 6.2%, and for the year as a whole we are projecting services sector to grow by 6.6%, and again by 6.4% the following year. But essentially we are seeing strength in the wholesale and retail sector. There's a recovery in the first quarter of this year. Accommodation and food services continue to register strong performance. Information and communication remains very robust. The financial and insurance sector also remains fairly strong. And finally, the real estate sector, we are projecting the real estate sector to grow by about 7.3%, which is the same growth it recorded in 2023. The leading economic indicators, this just goes to support our projection of 5.4% growth for the whole year. The leading indicators suggest that the growth in the second quarter of this year will be about 5.5%. As I said, we recorded a growth of 5.5% in the first quarter. So this is consistent with the growth projection of 5.4% for the year as a whole. And these are just indicators of performance in the agricultural sector, just some of the key crops. Maize has increased by 5.2%. You can see the most of the items identified there recording fairly substantial growth, except for rice, which experienced some flooding. But essentially, this is just an indication of the robustness in growth of the agricultural sector and the momentum that we expect that to continue for this calendar year. Turning to monetary developments, growth in broad money supply moderated in June of 2024, but this was partly due to the exchange rate valuation effects attributed to the appreciation of the shilling. So you can see there that around December of 2023, the M3, the broad money supply, increased, the 12-month increased by 12.2%. But most of that was because of the depreciation of the exchange rate that we experienced last year. But since that time, you can also see now that as of June, broad money only grew by 6%. And again, this to a certain extent reflects the appreciation of the shilling exchange rate. When we correct for the valuation effects of the exchange rate, we still see a slowdown in M3, broad money supply growth, from even about 13.9 in around February to 7.5. The decline is not as much, but nonetheless, we do see a slowdown in growth of M3, and we would expect that to happen given that we were tightening monetary policy during that time. The hump that we see there, even after we purge out the valuation effects of the exchange rate, where you can see there is a bump there from around June of 2023. That reflects the foreign exchange deposits as a result of the G2G oil agreement. Still on monetary developments, growth in credit to the private sector moderated from about 13.9, 13.8 at the end of last year to about 4% in June of 2024. Again, this the increase in credit to the private sector in 2023 reflects somewhat reflects partly the exchange rate valuation effects of depreciating exchange rate. There were some loans that are denominated in dollars, and even without any increase in credit in dollar terms, by the pure fact that the exchange rate is depreciating, results in an increase in credit to the private sector. And then similarly, in this year, you can see a significant decline in credit to the private sector from 13.8 to about 4%. Again, most of that reflects the appreciation of the exchange rate, and when we correct for the valuation effects, we still see a decline in credit to the private sector, but it is not a sharp decline as when you factor in the movements in the exchange rate. This is just another way of looking at credit to the private sector, where we just look at the local currency loans, and there you see by the end of December, around January 2024, that credit grew by 15%. But again, owing to the tightening of monetary policy, that has decelerated to 10.2%. And the black dotted line indicates the credit to the private sector, but denominated in foreign currency. And again, you can see the sharp decline there, reflecting the appreciation of the exchange rate. This is a reflection of the monetary policy framework. As we described in the past, we have introduced a new monetary policy framework. We now target inflation. And you can see from the chart on the left, where the pink, or rather the interbank weighted average rate fluctuates around, and there's no relationship between that, the interbank weighted average rate, and the CBR rate, which you can see there in blue. Until we introduce now this new monetary policy framework. And just to take you to the other chart on the right, you can see now that the interbank rate tracks fairly closely the CBR rate. So this has improved monetary policy transmission and made monetary policy much more effective. Turning to the balance of payments, the overall balance of payments deficit narrowed to US dollars 631 million in the 12 months to June of 2024, from $1 billion in a similar period of 2023. The overall deficit is projected at $1.1 billion in 2024, which should result in a reserve buildup of $662 million after taking into account the IMF financing. The current account deficit was estimated at 3.7% of GDP in the 12 months to June of 2024, compared to 4.2% of GDP in the 12 months to June 2023. And this reflected improvement in goods exports as well as remittances. The current account deficit is expected to remain stable at 4% of GDP in 2024 and also in 2025. And this is expected to reflect the improvement in exports, especially of agricultural commodities, the resilient remittances, trade and investment initiatives, as well as the recovery in imports supported by a stable exchange rate. The main external sector risks relate to the ongoing conflict in the Middle East, with a heightened geopolitical risk and global oil price volatility. These are just the details of the balance of payments, and you should be able to see the details when this is posted on the internet. So these are the depiction of the current account deficit, which has narrowed from 5.1% of GDP in 2021 and also in 2022. This narrowed to 4% last year, 2023. And this year, we expect that current account to remain broadly unchanged at 4% of GDP. And we do expect the 4% to be sustained over the medium term. And we think that this level of the current account deficit is consistent with moving towards a stronger sustainable debt position. With regard to goods exports, they increased by 11.8% in the first half of 2024 compared to a similar period in 2023. And this growth mainly reflected increases in exports of agricultural commodities as well as re-exports. There's a detailed table on individual exported items. We can see there that the vegetables, especially for the January to June, increased quite significantly by 23%. Fruits have also increased by 19%. Tea is also doing well at 10%. So generally, if you look at the very bottom there, you'll see that total exports are doing quite well, at least for the January to June this year, with an increase before re-exports of 11.6, and when you include re-exports, the total exports are growing by reasonable 11.8%. This is the direction of tea exports. Of course, Pakistan remains our key market, followed by Egypt and the United Kingdom. Tea prices sold at Mombasa, prices have generally been higher than in the previous years. The volumes on the right-hand side, these are the quantities of tea sold at the Mombasa auction. I think if you are to add what has been sold this year compared to last year, you can also see that the volume sold is higher than the volume sold last year. So we have higher prices this year and also larger volumes of tea auctions, and therefore we expect the tea sector to perform positively for this year. Similarly, with regards to horticultural exports, we see that the top table shows the volumes, and again you can look at the very last column and see that the volume of vegetables has increased quite significantly at 86.3%. The fruits and nuts have increased by 12%. Cut flowers have declined. But overall, horticulture, the volume has increased by 33.3%. In terms of values, total horticulture is expected or has increased by 12.3%. With regard to the imports, these have increased in the first half of 2024. These have increased by 3.6 from 8.69 last year to $9 billion this year. And this mainly has been driven by importation of machinery and transport equipment, although also the appreciation of the shilling exchange rate vis-a-vis the US dollar, that has also helped to incentivize the importation of goods. Again, this is just a detail of all the goods that are imported We do see a significant increase in sugar imports, but also down there below, you'll be able to see that there has been a significant increase in textile yarns and fabrics and articles, and this should help going forward in terms of exportation of textiles. And also the machinery and transport equipment recorded a fairly significant increase, and mainly the other transport equipment, which I think were locomotives for the SGR, you see a fairly significant increase of 297%. Diaspora remittances the inflows have accelerated. Last year we experienced only a 4% growth in remittances. The 12 months to June, we see an increase of 13%. And when we actually just take the first 6 months of this year compared to the first 6 months of last year, remittances have increased quite significantly at 17%. And we expect this trend to continue for the rest of the year. These are distribution of the sources of the remittances. Again, you can see that the United States, most of the remittances come from the United States. I believe about 55%. It fluctuates between 55% and 57% of all our remittances come from the United States. On tourism, we've seen the sector continues to perform very well. The total arrivals in the 12 months to June of this year increased by 27.2%. And you may recall at the end of December, the 12-month increase was 31%. So this sector continues to perform very well. We have seen some changes in the share of tourists coming from the United States, which still is the source of most of our tourists, but that share has declined slightly from 13.9% to 13.2%. And we've also seen a reduction in the United Kingdom, France, South Africa, and the Netherlands, and also Spain. But generally, the sector is performing relatively well, and we do expect that this performance to continue for the rest of the year. In terms of the usable reserves of the central bank, these have increased from 6.5 at the end of December 2023 to about $7.3 billion, and this is essentially equivalent to about 3.8 months of import cover, which is really sufficient for us to deal with any short-term shocks in the balance of payments. Looking at the exchange rate, the shilling, Kenya shilling exchange rate vis-a-vis the US dollar has strengthened by 17.7% in 2024, and this has reflected the improved foreign exchange inflows, particularly, as I said just a minute ago, of remittances, and also, of course, of exports, the impact of monetary policy measures, the impact of the recent reforms in the foreign exchange market, and the repayment of the June 2024 Eurobond. The chart to the right is a depiction of the exchange rate developments, but within the African continent. And again, you can see that the Kenyan shilling has performed, actually is one of the best performers in terms of strength vis-a-vis the US dollar globally, and also within the African continent. And you can also see the difficulties that the Nigerian economy is is facing with a depreciation of significant depreciation of the naira. And this is we also see the recent reforms in Ethiopia have also resulted in a significant depreciation of the birr. The shilling exchange rate has remained stable even in the face of recent credit rating changes, and also even during the protest that we have experienced. So if you look at that development in the exchange rate, you can see that it peaked around early 2024, and broadly speaking, since about March, has remained range bound between, let's say, 129 to about 133. And this is really a reflection of market developments. There hasn't been interventions. You can see that actually we are building our international reserves. So this is really reflecting a market-determined exchange rate. On the fiscal side, the government continues to be committed to reducing the fiscal deficit and having a fiscal consolidation over the medium term. The fiscal deficit in fiscal year 23-24 that just ended was 5.6% of GDP. The supplementary budget that has just recently been approved should result in a fiscal deficit of minus 4.3%. Of course, this is somewhat higher than the original budget that was submitted, which was targeting a deficit of 3.3%. But I think just to add that even with the fact of the withdrawal of the finance bill, we are still having, because of the expenditure cuts, we are still having a fairly substantial primary balance surplus, which is actually consistent with the discussion we've had with the IMF. But equally important is that the projected deficit now, which is about 770 billion, only includes domestic borrowing of about 413 billion. Now, this is compared to the domestic borrowing that we did last year of actually almost close to 600 billion. So under this budget and under the supplementary one budget, we should be able to reduce domestic borrowing by almost 200 billion shillings. And I believe that that should reduce pressure on treasury bill rates. And I think with the step that the central bank has taken of lowering the CBR, we should be able to see going forward reduced pressure on interest rates, and hopefully that this will trickle down to the banks, who would then lower interest rates as the treasury bill rates continue to go down. Thank you very much.
Thank you. And that was the governor of the central bank, who's also the chairman of the Monetary Policy Committee. And as usual, we shall take questions which are related to the MPC. And we begin with Rama Nyang of CGTN. So Rama asks, in issuing the DPO, the World Bank spoke of plans by Kenya to do another $1 billion buyback before the end of the year. Is there any update on these plans? Then Giorgio Bulutza from... Give us a second, please.
Continue.
So just going back, Ramanyang from CGTN is asking, in issuing the DPO, The World Bank spoke of plans by Kenya to do another $1 billion buyback before the end of the year. Is there an update, any update on these plans? George Obulutsa from Reuters News asks, how concerned are you about falling demand for Kenyan debt at weekly auctions? And how will this impact government financing plans? And what will you do about it? Those are related questions from Zainab Hafsa of Kenyan Wall Street, asking about the undersubscriptions around the bond auctions. And finally, from Bella Genga of Bloomberg News, what's the progress in seeking a fresh IMF program when the current one ends in 2025? How much and when do you expect the IMF board to disburse under the $3.6 billion program?
Thank you, Rama Nyang. Your question was whether we are going to do another $1 billion buyback before the end of the year. I believe we don't have such plans at the moment. What we are trying as much as possible is trying to talk to our development partners, both bilaterals as well as multilaterals, to get additional external financing. As I just mentioned a few minutes ago, what the current fiscal framework with the supplementary one budget has estimated roughly about almost 360 billion of external financing. Of course, that includes the proposed IMF completion of the 7th review and the other reviews. But we are in the process of seeking more external financing, and that way we can therefore reduce the access to domestic borrowing. As I mentioned earlier, this year we are projecting domestic financing of roughly 413 billion shillings. And the more we can, the more external financing and affordable financing on concessional terms, if possible, the more we can get of that, then we'll be able to reduce domestic borrowing, and then we'll really have both monetary and fiscal policy moving in tandem towards reducing domestic interest rates. I think on concerns about the falling demand for Kenyan debt at weekly auctions and how this will impact government financing plans and what we will do about it. I think, again, just as I mentioned, I think the proposed reduction in domestic borrowing should provide for lowered interest rates on treasury bills. It's still very early in the year. I really don't see that we will not be able to meet the domestic financing requirements. They are much lower this year than they were last year. So I don't really see any financing problem going forward, certainly in terms of funding the domestic financing requirements of the government. On the IMF program, I think, of course, the current program, the current ECF and EFF, and also the RSF come to an end in April of next year. Our engagement beyond that, I think, is still will have to be discussed. We have not reached any concrete decision on our engagement after the current program expires, but that will come at the right time. In terms of disbursements, we still have roughly about $1.4 billion of disbursements from the IMF to be made between now and the end of the financial year. Under the seventh review, we expect something on the order of just slightly over $600 million, and we do hope that a board meeting will be set soon so that those disbursements can be made. I think having said that, I think on the IMF, I think just to give a bit more color, I think we have done fairly well in terms of the IMF, the discussions and agreements that we've had with the IMF. Certainly in the case of the central bank, we have been able to meet all the performance criteria starting in even December of 2023. The targets we also agreed on the net international reserves for June we have met, and for December we are really on track to meet that target. I think similarly with other targets, the primary deficit, the government was able to meet the performance criteria through December. That was not the case in June. And most of the other quantitative performance criteria, whether it was guarantees or whether it was the contracting of new debt, also the guaranteeing of new debt, the government has met those quantitative performance criteria. The only one that really has been problematic is on the revenue side. We missed the target in December, and we missed the target in June. But having said that, I think the target were very high. Performance actually through June of revenues is quite. It's I think growth in ordinary revenue was about 12%, which I think is reasonable. And I think now the growth in revenues that we have in the fiscal framework for this year of with ordinary revenue growing by 15% is quite reasonable. And so I do believe that going forward we will be able to meet those revenue targets and also meet the consolidation path that should provide for achieving our debt sustainability target and our debt anchor of 55% of net present value of debt to GDP by 2028-2029.
All right, additional questions. We begin with Jimmy Mbogo from CTV. So Jimmy's asking, what necessitated the changes announced by the Central Bank of Kenya on the different denominations of banknotes? Similar question from Charles Moneki of Nation Media, who wants to know who is printing the new banknotes now that De La Rue closed its local operation. Stella Swake from Standard Investment Bank, who's asking, the recent credit downgrades could potentially weaken the Kenya shilling and lead to imported inflation. What are your views after the CBR cuts? And Samuel Njehia, who asks a similar question to Stella. Samuel Njehia from Renaissance Capital, do you think the Kenya shilling US dollar rate will remain stable even with a higher interest rate differential resulting from the 25 basis points CBR cut?
Okay, I think I think starting with the first, Mr. Mbogo, that what necessitated the changes on the CBK and the different denominations banknotes. This is just a normal process of the central bank. The notes that we have, they are getting old, and therefore we need to get new notes. That's really the reason. The reason why we started with the 1,000 notes was that they could be a stock out of those notes actually we are projecting there could be a stock out in around July, August, and so it was really necessary that we get new notes as quickly as possible. We've started with the 1,000, but the other ones will follow, and this is just the normal business of the central bank. The printing is being done by a German firm, and it's actually one of the best firms. So yes. I think on the issue of the credit downgrade, potentially weakening the Kenyan shilling, I think so far we have not seen that weakening. As I said earlier, we monitor the inflows and outflows of foreign exchange. So far, we are seeing more foreign exchange coming into the economy than going out, and so we don't expect that there'll be much impact of the depreciation of the shilling because of these downgrades. And the final question on Mr. Jehia is whether the shilling US rate will remain stable even with a high interest rate differential resulting from the 25 basis points. I think, as I said, we expect the rate to remain stable. And I also did indicate that that other advanced economies are also in the process of reducing their rates. So I don't see that interest rate differential is going to be there for a long time. The US is expected to lower their rates in September. So I don't expect that this interest rate differential will have any impact on the shilling-dollar exchange rate.
The final set of questions, we begin with Ken Abuya from Tech Cabal. Ken's question is in relation to Safaricom, where he says, in April, the governor said the regulator would meet the Safaricom board over the M-Pesa split from the telco business and the tax bill related to that. What's the progress? Ramanyang from CGTN again, what measures will the central bank take to ensure that the August 6th rate cut is promptly transmitted to borrowers, given the elevated non-performing loans levels among banks? And finally, from Ronnie Choka of AIB AXYS Africa, who asks, in light of the ongoing risk-based credit pricing framework, how responsive should commercial bank lending rates be to changes in the central bank rates?
Yeah, I think on the issue of the Safaricom and M-Pesa, I think what I said that the Safaricom would have discussions with the National Treasury on this matter. I'll have to follow up on that, on where they are with regard to that specific issue. I think on Ramanyang, if I take you back to the monetary policy framework, we now have this fairly strong and direct transmission of the policy to the interest rate of the banks. And because we have this inflation targeting model, now that we have lowered the central bank rate to 12.75, what we'll do is, in a sense, inject now more liquidity into the financial system to make sure that the interbank rate comes down to around that 12.75 rather than the 13%. And I think that way we can now we can have that transmission of lower rates to the commercial banks. And I think that is also related to the question by Ronnie Chaka that given the risk-based credit pricing, we do expect that now that rates are a bit lower, and as I said, with regards to T-bill rates, if we also those go down because of the reduced domestic financing requirements, that we would expect through the risk-based pricing model for the banks to continue to lower their rates. We will obviously monitor developments in that area and to see whether the banks are indeed using this risk-based pricing model to price their credit.
Thank you very much. And that brings us to the end of today's press briefing. This is a press briefing after the Monetary Policy Committee meeting of the Central Bank of Kenya. This MPC meeting happened yesterday for the month of August. And as usual, we expect the next meeting to be in October of this year. But if there's any reason for the MPC to meet before then, as we usually say in our press briefing, that will happen as of necessity. But for now, thank you very much for being with us, and do have yourselves a good day.